I just wanted to pop in here real quick this evening and introduce myself. My name's Kim Maldonado, and I'm the new VITA director. Jennifer and I have been here since August 1st, so we are quickly catching up on things, and I know I'm very excited about getting the tax trainings started and getting ready for January. So I'm going to turn it over to Jennifer now, and then she'll introduce you to our speaker tonight.
Hello, everyone. I'm Jennifer. I can't wait to meet some of you and finally connect some names with faces. So I have about over 100 names kind of flying around in my head. So I look forward to meeting you all. I have Jared here. He's ready to kind of get things rolling for our first training this season. If you all have questions, if you could do a little chat and put your question in the chat box. If you're having problems with that, you can always do the little raise your hand. But we prefer if you could please put the questions in the chat section. That way I can kind of document them. And then when Jared gives me the okay, we'll try to answer those questions. So I think we're ready. There's still people logging on, but take it away, Jared.
All right. Well, thank you very much. Great to be back here again. Great to have Kim and Jennifer helping out here this year, and certainly give them a warm welcome to the VITA community. Wanted to also go through and just kind of give you a little bit of information about kind of the overall training process. And what we're going to be doing today is really kind of going over a couple of things. One is going to be our changes in tax law here from 2021 to 2022. For those of you returning volunteers, hopefully it's going to feel a lot nicer this year because we actually have a little bit more of some actual benefits for the preparation community. We're going to work our way into, sorry about that. Hopefully, how are we doing on the screen here? Let me just change this 1 minute. Of course, all the time that I'm having issue with my computer all day long, and now all of a sudden, now it finally decides to work for me here. So let me go ahead and just correct this a little bit. Okay, and how are we feeling now with our view on the screen? Can we see the slides all right?
Yeah.
Okay, perfect. So I'm going to kind of guide you through the process here. Again, we'll be talking about some tax law changes, really what's happening here in 2022, and then getting into a little bit more of what we're going to be making the majority of decisions on here. And really, we're going to take a look at areas of filing status and dependency, which are really the two main areas that we have to do some sort of application of tax law and using our guidebook here to go ahead and help out with the tax process. So we really want to walk you through a little bit there. For those of you who are brand new to VITA, I don't want to scare you off with today's training. This is one of our more unique ones. We're going to talk a little bit more about some tax law, some tax rules and regulations, which are really more applicable for taking your tax certification test. And again, it's an open book, open note test. You can work on it in advance. So we want to help guide you through that as well. But we really want to be sure that you are kind of understanding the rules as they relate to what the opportunities are for dependency and then filing status as well. Once we get through today, the next week we'll be talking about income, and the following week we'll be talking about deductions and credits, and then we'll finish up with a little bit more of issues on state and local filings and some more advanced topics. So we'll really kind of guide you through a little bit of an entire overview of the tax return process and hopefully get you enough information to have you ready for the next training series that'll coming up, which will be our computer training, and get you ready for the tax season. So now we move down to getting back into the who must file return. So this is generally where we take a look at who would have to file an income tax return. And this is actually based on three different areas. One is going to be our filing status. One is going to be the age at the end of 2022, and also the gross income. So what you'll also notice, if we take a look in the upper corner of these slides, you'll see a reference A1. And not trying to promote steak sauce or any type of condiment. What A1 is actually the reference number for the form publication 4012. So the 4012 will actually be organized in various sections, and I want to just highlight where the information is coming from for your reference. Now, the form 4012 is not yet available in print form. However, if you wanted to get a copy, you can actually basically go out to the IRS website and download copies of the publication 4012 or the publication form 441. And also the testing materials are also available online. So you actually have access to these materials even in advance. So really, it gives you an opportunity to kind of have those as a quick reference guide or have the ability to take a look at some of these questions before we even get into the tax season. So we're going to be talking about filing status a little bit later on this evening, just understanding what the 5 options would be. And really what we're taking a look at is how do we determine whether or not someone must file an income tax return? So again, the 3 criteria are going to be based on filing status. So that one will determine which one of the 5 they should fall into. Age, good news is we don't really have to make any judgment there. That's going to be based on their birth date. One time a year, we actually get to ask someone how old they are without feeling bad. And then we also have to determine their gross income. And gross income we'll cover in a little bit more detail next week when we talk about income sources, but predominantly we're going to be taking a look at how much income from a taxable perspective have they received. So there may be some things that are a little bit different. They may not fully have all of their Social Security income taxable. There may be a couple other things we take a look at, but just as a general reference for taxable income, what would we be looking at? And the numbers are basically coming from the fact that these are our new standard deduction numbers for the year 2022. So for a single individual age 64 or younger, they will have a standard deduction of $12,950, which means anything above that, they could potentially have a tax liability. If they're age 65 or older and they're single, they actually get a nice little benefit. That's up to $14,700. Married filing jointly, if they're under 65 for both of them, they have a double the standard deduction for single. So the marriage penalty you hear about potentially does not apply to standard deduction. Now, unfortunately, however, as a married couple is aging, they do not get quite the same increase as a single individual does. So we'll see a little bit of a change in their standard deduction, not quite as great as what happens under the single status. So just want to kind of point that out. Another one we're going to take a look at a little bit later, filing status not usually recommended is going to be married filing separately, and you'll kind of see why that is a little bit later. But really doesn't matter what age you are. Potentially, you can have to file a return if you have $5 of gross income. And the reason why $5 of gross income is if you do not have a standard deduction, which you may not if you're married filing separately and your spouse files with an itemized deduction, you must itemize your deduction, even if you do not have any. So that may mean that you actually have to pay tax if you have $5 of income. Well, how do we get to $5? $5 of income at a 10% tax rate would be 50 cents. 50 cents is going to round up to $1. So the taxpayer would actually have a $1 tax liability. A couple of the other special categories we'll talk about as well, head of household and qualifying surviving spouse. Both of those have a fairly nice standard deduction, a little bit higher than the single individual, and the qualifying surviving spouse, which is actually a new name for our qualifying widower with dependent child, is actually the same rate as what you would have for married filing jointly. So just want to point those out. So those are basically what we take a look at. Now, those are really designed here from this chart to help you with the exam process to determine when the IRS asks a question. If you have a 27-year-old individual who has $10,000 of income, would they need to file? And the answer would be if they're single, they're under age 65 and they have $10,000 of income, they technically do not need to file because their income's not above the gross income test. However, there may be some individuals that also have to file even if they do not meet the thresholds. So there's a chart C on, again, page A3 of your 4012 that'll talk about these different circumstances. The biggest ones we're going to see are going to be net earnings from self-employment. If that's greater or equal to $400, they would need to go ahead and file a return. So what we're taking a look at here from that process is that we would have any type of self-employment earnings that could be from driving for Uber or Lyft. That could be from areas like babysitting. It could be from side economy or a side hustle, side gig, whatever you want to call it. If they have more than $400 of net earnings, they will have to file a tax return because they will owe self-employment tax. Also, if they have received a non-qualifying distribution from a retirement account, they may owe tax or penalty on that distribution, so they have to file a return. Another situation could be if this is an individual or a couple that had taken out a repayment type credit. Usually those are going to be things like the first-time homebuyer credit. It would be one in which they'd have to file. Fortunately, those individuals know they have a tax filing responsibility. One of the biggest ones we have is effectively the advanced premium tax credit. So if we have a individual who has taken health insurance off the marketplace and they have received an advanced premium tax credit, they will have to file an income tax return. And we'll talk a little bit more about that when we get into deductions in healthcare. So that is basically the who must file rules. I want to talk a little bit now about the who should file. And basically what we say is anyone who comes into VITA should probably file a return. If they've made it through our checks of calling for an appointment and they made it through the greeter process, they probably should be here to file a return. But a couple of situations that present themselves, the only way to get a federal refund is to go ahead and file a return. So what would be eligible for a federal refund if you've had federal income taxes withheld, if you paid any estimates, if you've had the ability to have a carryover from a prior year. Also, if you've received a form 1099B or 1099S, if it sounds like I'm just going ahead and saying a bunch of numbers here, we're going to talk about the income next week. So those are actually forms that we are going to be collecting from the taxpayer that present sale of business or personal assets. So it could be sale of stock, it could be sale of securities, it could be a sale of a home. One of the biggest reasons we have individuals come into VITA is for tax credits. So what we're going to take a look at here is the ability for an individual to take advantage of a refundable credit or to offset their tax liability would be earned income credit, additional child tax credit, a portion of the American Opportunity Credit, which is an economic credit for educational purposes. We have the recovery rebate credit, and quite popular is the senior citizens who are eligible for PA property tax or rent rebate. Now, a question had been posed earlier today, do we still file a federal return, even if a senior citizen may not be required to do so? And the answer is yes, we can still file a federal return. Generally, we probably need all that information on the federal return to generate the PA property tax rent rebate credit. So certainly not a problem to go ahead and actually prepare and file the Form 1040. If for some reason they do not have any taxable income, if they only have Social Security income or something along those lines, we can actually prepare a return by putting $1 in as other income and basically notate that it is a income not reported elsewhere and described in order to e-file. $1 of income will not generate a tax liability, but will allow that return to be electronically filed. One other thing I just want to mention before we head into a couple of our decision areas would be mailing addresses on returns. So we just want to be sure that when we're actually filing the income tax return, we actually use the current mailing address for the client. So even though that address might be different than we had on the prior year, or might be different than what was shown on prior documents, we have to use the current address where they're currently living today. So we may need that information for the IRS to maybe issue a refund, or if there's notice or correspondence that they need. So we need to have the most current information on file. Now, we may have some additional information needed for state or local returns, just where the individuals had lived, making sure that we have reported that correctly. So we may need things like their local municipality or their school district, but we'll talk about that a little bit more with state and local taxes. So before we move into the area of dependence, just want to check and see how we're feeling right now. Any questions so far on overall return process, changes in the 2022 rules, or anything we've talked about from a filing perspective? Just wanted to double check and see how we're feeling with those. Okay. We'll go ahead and continue on here. And again, if you have any questions, feel free to go ahead and just drop that in a chat down there, and we'll go ahead and be sure to pick those up. Okay, so moving into our next issue for the evening, and that's going to be dependency. So one of the areas we take a look at is typically a return will be filed by the taxpayer, and if they're going to be filing jointly, their spouse will also be on that return. But we also have the ability to claim dependence. And dependence can help for a variety of reasons. First, we have a couple tax credits that belong for claiming a dependency. That could either be the child tax credit or dependent for other individual. So a lot of the rules we're going to be taking a look at for dependence are on C1 of your 4012. That's kind of where we get that information started from. So a couple basic rules we're going to look at. So in order to claim a dependent, the individual themselves cannot claim a dependent if she or he is also claimed as a dependent on someone else's return. So if you can be claimed as a dependent on someone else's return, and not that you are, but just that you could be claimed as a dependent by someone else, you are not allowed to claim any dependents, which probably makes more sense. So a situation may arise where you may have an individual living at home, maybe you have a 19-year-old with a young child, and they're off in school or they're working part-time and they don't really have a lot of income. But they're also living with their parents, and their parents can still claim them depending on how much income they have and a couple other factors. So if they could be claimed as a dependent by someone else, then they themselves can't claim another taxpayer as a dependent. So we usually don't run into that, but I just want to point that out from a tax law perspective. When we take a look at dependent rule, the person being claimed as a dependent has to be either an unmarried individual, and now we'll get into a couple IRS exceptions and then exceptions to those exceptions. So typically a dependent is going to be unmarried, probably not out of the realm for someone who is going to be a child or someone along those lines. If they are married, they cannot file a joint return, but then there's an exception to that rule. So if they are married and filing a joint return only to get a refund, then they're okay. That's going to be fine. But another issue we'll take a look at is really kind of residency or citizenship. So the dependent has to be a U.S. resident, a U.S. resident alien, a U.S. national, or a resident of Canada or Mexico. So we're not talking about necessarily citizenship so much as are they a resident of Canada or Mexico? Are they a resident alien? Do they have a U.S. national certification, or are they a U.S. citizen? If there is a adoption pending, that can also change as well. We don't know if often see that here in our cases, but theoretically an adoption case could allow for someone to be considered a dependent. When we take a look at dependency, we have two options for dependents. One is a qualifying child, and that's going to be our primary test. That's what we're going to look at first. So what we want to take a look at here is the individual going to be considered a qualifying child, or is that dependent going to be considered a qualifying relative? So we'll go through both tests and just kind of take a look and see what the similarities and differences are between the two. So the first one I want to take a look at is qualifying child. Now, one of the things I typically do when I start off my tax courses up at E-Town College is to just have my class imagine in their minds what the definition of a child would be. And usually we'll have people kind of share their thoughts, and a lot of times you'll get the idea that a child in their minds is probably a toddler or maybe a preteen, someone who's basically related to a taxpayer. And some of those are accurate, but we're going to tell you a little bit more about how the IRS defines what a qualifying child is. So we're going to start off with a unique concept. So we're going to start off by saying that person must be the taxpayer's child or stepchild. Okay, we're good with that. But now we get into a unique scenario. They can also be the taxpayer's brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendant of any of them. So now we've moved from a definition of child to also include your siblings, including your brothers and sisters and half-brothers, half-sisters, and steps, and also descendants of any of them. So now what we're taking a look at is not only are we looking kind of an opportunity for your own children, but also take a look at your brothers and sisters going out from a lateral move and then going down from there. So your nieces and nephews can also count as qualifying children. Grandchildren can count as a qualifying child. So they can even count if they're adopted or an eligible foster child. So the first thing we have to take a look at is that relationship test. So there has to be some sort of relationship. They're either related to you by being a child or grandchild, great-grandchild, or brother or sister, or any descendants of them. Then we have a couple other rules that we need to take a look at. One is an age test. And that's going to be taking a look and seeing, is that individual younger than the taxpayer? And kind of an odd concept again of why would we be asking about whether or not your child can be younger than you? Before we get into how well does the IRS understand biology, the reason why we're asking this is because when we've expanded that rule of child to include your brothers and sisters, it allows for a taxpayer to claim anyone related to them as long as they are younger. So what we might be looking at is a situation where you have a family and the oldest sibling is off working and providing for the other siblings. Maybe the parents aren't around. They can actually claim their brothers and sisters as dependents because they're actually meeting all the other qualifications. So as long as that individual is younger than the taxpayer and either under the age of 19, so we're looking at the end of the year, are they under the age of 19? Or are they a full-time student under the age of 24? Now, when we take a look at the definition of full-time student, again, if we thought the definition of child was a little unique by throwing in brother and sister, what we're looking at for the definition of full-time is probably a little bit different than most people would probably define full-time. What we're looking at as a full-time student would be any student who attended at least half time. So at least you have half credit. And the schools will indicate that. They will indicate whether or not they met the halftime credit load for financial aid eligibility. We also take a look and see full-time actually means any part of 5 months of the calendar year. So when we take a look theoretically at a traditional academic semester, if we take a look at a spring semester, typically individuals will matriculate in late January. So even though they're not there for more than maybe a week or two, January still counts as a full month. And then they're there for February, March, usually spring break comes around, they're there for April, and then usually graduation happens right at the beginning of May. So even though it's not 5 full months, it's 5 partial months, and that's enough to count for a full-time student. So as long as you're under the age of 24 and a full-time student, or under the age of 19, they're going to meet the age test. Now, if the individual is permanently disabled, they can be any age. And we don't have an age test for anyone who might be permanently disabled. So that may occur. I have a client of mine who cares for a sister with a disability. She is considered a total and permanent disabled. So that gives him the opportunity to claim her on the return as a qualifying child. Now, the other issue we take a look at is the child must live with the taxpayer for more than half the year. Now, what's interesting about that is temporary absences do not count. So if a child's away for things like education, or if they're away for a vocational program, or if they're away for a variety of purposes, they don't actually have to live there full time. Those temporary absences will not count against you. They're actually counted as living in the household. So it does help out quite a bit. One unique aspect when we talk about a qualifying child is they cannot provide more than half of their own support. So it doesn't mean we have to provide the support to claim them as a child. It just means that the child does not provide more than half their own support. And one of the things we look at here with what do we mean by support, it literally means how much is a child paying to take care of their own support needs, housing, clothing, food, that type of thing. If a child's working and they decide to save their money for college or saving up for a home, that's not going toward their own support. So as long as the child themselves does not provide more than half of his or her own support, they're going to meet that test. Again, we talked about that joint return test. They can't file a joint return unless only to claim to file a refund. And they can't be a qualifying child of someone else with a higher priority under the tie-breaking rule. So we have to take a look and make sure that we have a good understanding of who could be a qualifying child, and make sure that the taxpayers know what the tie-breaking rules will be. So a couple other things I just want to mention about support is if an individual is receiving certain benefits, generally support from the state and other agency will not count as support from the child. So if they're eligible for food stamps or other programs, it's not going to count as the child providing their own support. However, if the child is receiving SSA benefits and using those toward their support, that is treated as being paid by the child. So as long as they're not paying for more than half of their own support, they should be in pretty good shape. So the next thing I want to take a look at is really the rules on the child tie-breaking rules. So because we have a couple different options, theoretically, if you have a parent of a child living in a home and the grandparent of the child's living in the home and an uncle's living in the home, all of them could qualify under these rules for a qualifying child. They're all going to meet the relationship test. The child hasn't changed in age, so they're going to meet the age test. You're going to live with the taxpayer for more than half the year. As long as the child didn't provide more than half their support, then multiple people could theoretically claim or attempt to claim the child on their return. Good news is the IRS has already considered this and has a pretty robust tie-breaking rule system in place. So if we take a look, if the child's a qualifying child, more than one individual, we'll just take a look and see who actually wins out on the tie-breaking rules. So if the individuals are trying to claim the child and only one of the individuals happens to be the child's parent, that parent's going to win the tie-breaking rule. The parent has first priority to go ahead and claim the child. Now, if both parents are trying to claim the child, and they, I'm not quite sure why the IRS has to go ahead and put in here who do not file married filing jointly. Well, if you're filing jointly, it's going to be on the same return, so you probably shouldn't be fighting over who gets to claim the child. But if parents are not filing jointly, if they're going to file separately, who gets to take the child? Well, the tie-breaking rule would say, well, the child parent gets to take them, but if both parents are attempting to take the child, then it goes to the parent with whom the child had spent more time, who they live with for the greater period of the year. And with that, we can have the IRS come in and they'll go through a couple things like school records or maybe where's the primary residence of the child. So they'll take a look and determine where did the child live for the greater portion of the year. So that would be who gets to take the child as a dependent. Now, if both parents try and take it, again, they're not filing jointly, and the child lives with each of them for the exact same amount of time for the year. Then the default position is going to be the parent who has a higher AGI or adjusted gross income. So whoever has more adjusted gross income would get to take the child as a dependent if they live with that child for equal amounts of time. Now, if no parent decides to claim the child or no parent can claim the child, then the next person in line would be the person with the highest adjusted gross income. Now, uniquely, we can have a situation where a parent may be able to claim a child, but chooses not to do so. And the reason could be maybe the parent doesn't have sufficient income that having a child tax credit would be worth it. They're not going to really get much of a tax benefit. They can actually decide, I'm not going to claim the child this year, and someone else can. But that individual has to have a higher adjusted gross income than that parent. So what we have to do is just make sure that if an individual wants to take a child, maybe they're going to say, I'd like to take my grandchild this year. The child's parent is not going to file a return or is not going to claim the child. That is fine. They can actually do that under the tie-breaking rules, so long as your adjusted gross income is higher than that of the parent. All right, how are we feeling so far? Just want to check in and see if any questions have developed yet. Okay. I'm going to now take a look at a special rule for non-custodial parents. And this is going to be taking a look at what happens if we have a situation where an individual who does not have the child living with them would want to claim the child. And that's certainly possible. Typically, this may arise in situations where there's a shared custody or maybe coming out of a divorce agreement that a non-custodial parent may claim a child. Now, just as a reminder, a non-custodial parent really doesn't have a whole lot of kind of a leg to stand on when it comes to tax law. If the non-custodial parent and the custodial parent both file to take the child as a dependent, the IRS is going to rule in favor of the custodial parent because that's where the child spent more than half their time. So we just want to be cautious if you're working with a non-custodial parent to be sure that we actually have the evidence that we can go ahead and present if needed, or the taxpayer can, if that claim is challenged. The best way to do that is to actually have what we show as a Form 8332. This is a form signed by the custodial parent that says, I'm going to release the dependency of that child on the return to the non-custodial parent. The IRS takes that as a absolute. So they will go ahead and whoever has that Form 8332 signed will be eligible to take the child as a dependent. Doesn't matter anything else that happens. If not, then the IRS can come back and take a look at the who has the child for the majority of the year. And usually the way this becomes a problem is if you file a return and you think you have the dependency exemption all lined up, and then all of a sudden you get an e-file reject notice because someone else claimed the child, you can still file the return. We'll just have to file it by paper, and then the IRS will come back in and make their determination as to who actually should claim the child. A couple benefits that occur once we have a child on the return as a dependent. So you can get the credit for other dependents or the child tax credit. That's usually a fairly nice one. Head of household status and the earned income credit are also ones that are pretty popular. If you have a credit for child and dependent care expenses, or if you've had money withheld from your pay for dependent care benefits, that can also be a nice feature of having a child as a dependent. Now, you can also split that a little bit. So a non-custodial parent, technically, if they're eligible to claim the child, can claim the child for the child tax credit and also for any education benefits. Now, the custodial parent still is actually eligible because they have the child for the greater portion of the year. They're still eligible for the earned income credit, the credit and dependent care credit, exclusion from income for care benefits, and also head of household status. So just a couple unique things we need to keep in mind for non-custodial parents. Again, generally, we'll keep asking questions with the taxpayers. We'll go through a flow chart, and those are found within your 4012, and a great resource to go ahead and use to determine whether or not an individual should be considered eligible for a qualifying child. So the next rule we have, if we find that someone is a qualifying child, we stop here. That's all the further we go. If someone meets the criteria for a qualifying child, we don't need to go to any other rules. The only other time that we go to a qualifying relative piece, this is our second dependency opportunity, again found on C4, would be if they do not meet the qualifying child rules. So we have to go through the qualifying child first to make sure they don't meet those rules. And then we move on to what we call the qualifying relative. Now, the unique part about the qualifying relative is we're actually going to go ahead, and the first definition I'm going to give you is someone not even related to you at all. What we're looking at is an individual who lives with the taxpayer all year as a member of the household. What does that mean? That you've taken in a friend, you've taken in someone in your house, it could be a companion, it could be any type of relationship, as long as it's not violating local law, and they're with you all year long. And we literally mean all year. We mean from January 1st, from the day that you wake up, and if you're here in Central PA, you're getting your pork and sauerkraut ready, all the way through New Year's Eve. It has to be the entire year. So they have to live with you all year as a member of the household. So the other criteria would be, or they're related to you. And the qualifying relative piece is kind of broad. It's really taking a look at a relatively long list of possible relatives to you. So we're going to go back and take a look. We mean child or stepchild, eligible foster children, grandchildren, great-grandchildren. So again, we're kind of going down literally. We're also going to take a look and see your ancestors. So that would be your father, your mother, your grandparent, or other direct ancestors. Foster parents don't actually count, but stepfathers, stepmothers would as well, going out basically horizontally. So we're going to take a look at your brother, your sister, your half brother, half sister, stepbrother, stepsister, and any of their descendants as well. So again, we're taking a look at nieces and nephews, aunts and uncles, brother-in-law, sister-in-law, father-in-law, mother-in-law, son-in-law, daughter-in-law. So it sounds like it's a fairly robust definition. So what we're taking a look at here is generally, if they're going to show up in your family tree, they're probably going to be considered a qualifying relative, with one notable exception. So one of the things we're going to take a look at is a cousin is not listed as a relative. So a cousin is not a relation aspect for the qualifying relative. In order for you to take your cousin as a qualifying relative, they have to live with you for the entire year as a member of your household. Now, before you get excited and you start thinking, well, maybe what I could do is actually have all these people move in with me January 1st. I'll keep them there for the entire year. I'll make sure that they're doing well. I'll be sure at the end of the year, I collect their social security cards and ID and can go get a couple more dependents on my tax return. One of the main things we have to take a look at is their gross income cannot exceed $4,400. So $4,400 is a relatively low threshold. Now, that does not include income that's not taxable. So it does not include things like any type of scholarships or inheritance. It generally will not include Social Security. So Social Security is a little bit different. It generally has to exceed about $25,000 or $32,000 for married filing joint. So those are going to be issues we take a look at. What does gross income actually mean? Also, if you have an individual who is working for a sheltered workshop or has state benefits, that's not included in income either. One notable exception. Now, we've taken effectively the fact that they have to live with you off the table, other than the non-related person. But now we've moved it from the fact that you now have to provide more than 50% of the person's total support. So it's no longer that they don't provide 50%. You have to. So now only one person can theoretically qualify for a qualifying relative. So that's one of the issues we're going to take a look at. It's generally going to be whoever provides that support. Whoever has the majority of the housing, the clothing, the food, that type of thing would typically count for the qualifying relative. Okay, before I move on, how are we feeling so far? Any questions that we're running into? Anything popping up on chat here? Okay. And if you do have questions, I'm happy. You can probably tell we're not on a timed recording here, so I'm happy to entertain questions as they arise. So if things pop in your head, feel free to throw them in chat, and we'll catch up to you as quickly as we can. So now we want to talk about our filing status. Now, my grammar is not the best. I'm not a proponent of Latin studies, so I'm not quite sure if it's filing statuses, filing status, filing statusi. We're going to call it, it came up earlier today, filing categories. Makes it a whole lot easier to work with. So there are 5 ones we can actually utilize. And what we're going to be taking a look at is the second part of our session today is about filing status. First question is, can we take a dependent? Second question is, what's a filing status? So that information is going to be found on B10 and B12 of your 4012. And we want to go ahead and take a look and see what our possibilities are. There's going to be 5. We're going to talk about the single status, married filing jointly, married filing separately, category called head of household, which we'll take a look at what the qualifications are. And the last one is an amount that has been around here before, but the name of it's changed. It used to be called qualifying widower with a dependent child. They've now shortened it down to just call it qualifying surviving spouse, or QSS. However, I personally feel that it is less descriptive than what we had before. The first title was a lot longer, the qualifying widow or widower with dependent child, but it told you what you really needed to have in order to qualify for that status. But we'll get into that a little bit more in the next few minutes. So I want to kind of get into the very first status we have, and that's single. So the single status is really determined, or actually all filing status are determined on the very last day of the year. So what we want to take a look at as of the end of the year, December 31st, are you unmarried or legally divorced? So are you legally divorced or are you unmarried as of the end of the year? If that's true, then your filing status is single. Now, there may be some more status that could apply. We'll take a look at that in a little bit. But your basic response, if you are not married as of the end of the year, you are single. So hopefully not overly complex for individuals to determine whether or not they're married. It does not include a couple other things that we'll talk about. Does not include kind of any other type of relationship that's not considered a marriage. So if they have a Facebook status of it's complicated, it probably means they're not married. So we'll take a look and determine what they actually have. One of the things we do want to just take a quick note of is we do ask clients the information. So we're going to ask them what was your relationship status as of the end of the year. So pretty much we're going to go ahead and whatever they tell us, we're going to go ahead and take at face value. If there's information you feel may not be exactly accurate or forthcoming, feel free to ask the question in a similar manner and maybe slightly different choice of words, just to make sure that we're consistent in our responses here. But if they're going to tell you they're single, we'll go ahead and take them at their word unless we know that they're not. If they show up with a top of their wedding cake or their wedding album, you may want to say, are you sure that you're single? Because you're bringing a lot of evidence that says you're not. But traditionally, we're just going to go ahead and take them at their word. Another issue that may come up is you may ask an individual to say, I see that you're listed down here as married. I don't see any information on your spouse. And they said, well, my spouse actually died in 1989. Okay, well, I'm sorry to hear your spouse has passed away. However, you're not considered a married individual. You're considered single. So a widow or widower whose spouse died before the current year is traditionally going to be a single individual unless they meet a qualification for that qualifying surviving spouse. So typically, if someone comes in and believes that they're married, but their spouse is deceased, they're probably going to be considered a single individual. Now, moving to the next area and really taking a look at the married filing jointly category, we're taking a look at determining individuals, are they now married as of the end of the year? So if on the last day of the year, they're married and living together, that's fine. If they're married, married and living apart, but not legally separated or divorced, they can still file together. If they're separated under an interlocutory or kind of temporary divorce degree, they're still considered married. If they're in a common law marriage, we don't have those here in the East Coast or really in PA, but they can still file jointly if they're considered married. So we're going to take a look if they are married as of the last day of the year, they may elect to file jointly together. If their spouse has died in the current year, so if the spouse died in 2022 and the spouse is not remarried, they can file jointly for that return. So as long as they meet one of the tests, they're okay, as long as the spouse didn't remarry. Now, in a unique situation, if the spouse does remarry, we probably have a couple issues. One, if they get remarried right after that funeral service, we may want to take a look into the cause of death. I'm sure the insurance company wants to take a look and see what happened. But what would occur in that consequence is the deceased individual would now have to file married filing separately. The spouse would now file potentially jointly with their new husband or wife. So just one thing we want to take a look at there. Should not really arise all that often, but just in case it does, just want to give you the Hack's Law version behind it. A couple other things, just to remind you, same-sex couples can file jointly as long as they were legally married in a jurisdiction that recognizes their marriage. Right now, all states recognize same-sex marriages. However, it has to actually be a marriage ceremony that is recognized. So registered domestic partnerships, civil unions, other relationships do not count as marriages. So we would not consider them married for tax purposes. Now, another area that arises, let me just see. Okay. All right, I'm sorry. We have a question coming in on the chat. Confused on legally separated end of year as opposed to divorce. So what we're taking a look at is we have in Pennsylvania, we do not have a legal separation. For Pennsylvania purposes, you're either married or divorced. So for our returns here within VITA, we're more likely going to take a look and see, are you actually single? Are you married, or are you divorced with a final divorce decree? So if you have the final divorce agreement by the end of the year, then you could be considered single. If the divorce is still in process, you're still legally married under Pennsylvania law and could either file married filing jointly or potentially married filing separately, which we'll talk about in just a little bit. Did that help answer your question? Okay. So one of the other things we're going to take a look at is if you don't want to file together, you can file separately. And for the most part, this probably is not going to be your best filing status. You have that election. The benefit to have a separate return is you have no joint liability. So if you file a joint return, the IRS can go after either or both parties for payment of taxes, assessment of penalties or interest. If you file separately, they can only go after the actual taxpayer. Now, in very limited circumstances, the couples may pay less tax overall, and we have walked through a couple scenarios where that could happen. Potentially, it could be a situation where you have a couple that has a fairly large age discrepancy between the couple. One may still be working, the other may be collecting Social Security. The individual on their own may be exempt from tax or pay a little less tax if they file separately. But generally, we're not going to run into that situation all that often. In most cases, in almost every case, a couple are going to be paying more tax by filing separately. So why would people want to file separately? And you may get a couple different things that occur. You may have a spouse say, I don't really understand everything on the return. I'm not quite sure that I fully believe that everything on that return is accurate. Well, that's a valid process because if you do file a joint return, you're going to be jointly liable for anything on that return. Now, there is an exception, and this usually comes about in cases of audit. So if you have a situation where an individual has filed a return with their spouse and the IRS comes back and now makes a determination that return has had some information on there that probably was not accurate. Maybe they underreported income or overreported expenses. Generally, both taxpayers are going to be liable. However, under an innocent spouse relief, that the individual who was not the one creating the problems can be held basically without any liability. It's not their issue. They're not the ones that created the problem, so they're not going to be held liable. But they have to be innocent. They have to have no knowledge that there was any type of fraud or any type of inaccurate information on the return because they jointly signed it. So generally, the innocent spouse relief comes into play only if the return's audited. And what do we mean by innocent spouse? If they truly had no idea that there was money that was collected but not being reported, or there were some expenses that were overstated, that's going to be our classic definition of innocent spouse. An innocent spouse is not someone who actually had knowledge or should have had knowledge. So, for example, if your spouse works full-time in a self-employed business, they're gone 40 to 80 hours a week, but at the end of the year, their tax return shows that they made $4,000. It probably doesn't really make sense. If they come back and they pay the mortgage every month, if they drive brand new cars every few months, if they take nice vacations, they go out to eat all the time, the IRS is going to say, well, you should have known that can't be possible based on the amount of income reported. So you may lose the innocent spouse provision at that point. So that might be one issue that we have, that people may not actually want to file a joint return if they know that there is fraud. Yeah, that will not give them innocent spouse protection. And they may say, well, okay, I do want to file separately. I just want to caution there are a couple things that happen with that married filing separately. So a couple things that happen. We have a lost or very limited credit for earned income credit. One of the biggest reasons people come into VITA if they're working is for the earned income credit. They also lose the credit for the elderly, the child care credit, the adoption credit, all the education credits. They'll lose education benefits, including student loan interest deduction, tuition and fee deduction, savings bond interest exclusion. Also, we talked a little bit earlier about the standard deduction. If one spouse itemizes and the other one also has to itemize. For Social Security, you have a greater percentage of your Social Security taxed if you're filing separately. Other things that we take a look at are little less popular, but IRA deductions and contribution phase outs a little bit higher. Capital losses aren't allowed to the extent that they are for married or single individuals. We have some other limitations on home sale exclusion. But now one other reason that people may say, I don't want to file separately because my spouse has a past debt due to the federal government. And that could be a federal tax balance due. It could be a child support payment that's in arrears. It could be a student loan payment that has fallen behind and the government's going to withhold the refund. Well, and it's a very valid concern. If you file a joint return and you have an $8,000 refund and your spouse owes $12,000 to the government's going to take all of your refund. They're going to take all $8,000 and apply it to the outstanding balance. So you may say, I don't want to lose all of it. Maybe I'll just file a separate return. I'm not going to get as much, but at least I get something. So I just want to point out that we do have the ability to file what's called an injured spouse. So not an innocent spouse, but an injured spouse form. And that's actually available within our VITA program inside TaxSlayer. That's the form 8379. And that allows you to effectively say how much of the refund belonged to the taxpayer and how much of that refund belonged to the spouse. The government's going to go ahead and say, okay, out of that $8,000 refund you're eligible for as married filing jointly, if only $2,000 belongs to the taxpayer, that's all the government's going to take. They're going to withhold $2,000 of that refund, and the spouse, the injured spouse, is going to get their $6,000 refund. And they're still eligible to take the earned income credit, the child care credit, the education and adoption credits as well. So kind of an option to take a look at in case we're running into problems there where people just do not want to file together. So if you've had that situation, you may just want to go ahead and talk to the taxpayer a little bit and just get a sense of what they would like to do in terms of filing. Okay, so those are our standard 3 filing status. Effectively, you're either single or you're married as of the end of the year. And then if you're married, you have the choice to file jointly or separately. But now we're going to take a look at a couple special filing status. And one would be the head of household. One of the ones that people take a look at, a lot of people want to be considered head of household. They have to meet all of the following conditions. Now, I just do want to caution. People may say, I definitely want to be head of household. I talked to my friends. I saw it on social media that head of household's the best status to have. It sounds the best of all of them. I mean, quite honestly, single doesn't sound that great as opposed to head of household, that you get to make all the decisions. You get to basically run everything that's inside the house. It sounds pretty nice. But the head of household status only does a couple things. One, it gives you a slightly higher standard deduction than you would if you're single. It also gives you the ability to have a different graduated tax rate. So what you're basically doing is you're not going to get any refundable activity from head of household. It's just going to reduce your amount of potential taxable income or tax liability. So the only reason I say that, I just want to caution and make sure that we are looking at these rules and ensuring that we're actually having the correct individuals file as head of household. So don't always take a look at the prior year return and just assume that those dependents will always be there, or the filing status we used in 2021 will also be the same one we use in 2022. Use your flow charts, use the guides that we have in the 4012, and it'll help you go through that decision-making process. Now, in order to qualify for head of household, you have to meet all of the following tests. So you have to be a U.S. citizen or resident for the entire year. So not a part of the year. This has to be the entire year that you're here in the U.S. So that means if we have refugees that have come in, they are eligible to go ahead and file returns, but they can't take head of household status. They have to be a resident for the entire year. They're not married as of the end of the year, which, okay, sounds like a single classification, or they're considered unmarried. And we'll talk about what considered unmarried is. This is a definition only available within inside the Internal Revenue Code. The other thing that has to happen is they have to pay for more than half the cost of keeping up a home. That's where the head of the household concept comes in. So what we're looking at is they have to pay for more than half, not just half. It has to be more than half. So theoretically, what the government's going to be looking for is that each home should only have one head of the household. So each street address should only have one person that's paying more than 50% of the cost of keeping up the home. Technically, only one person can pay for more than half the rent and utilities. We'll talk about what that classification will be. The home has to be a principal residence for more than half the year for either a qualifying child. And again, we kind of talked about what the qualifying child is. Now, the only difference between the rules for head of household as a qualifying child and a qualifying child for dependency purposes is head of household. You can actually get that qualifying child even as a as a custodial parent. So even if you gave the dependency exemption away to a non-custodial parent, you can still take that child to get you to qualify for head of household, not as a dependent, but that child can help you qualify for head of household status. For the qualifying relative, again, we have a couple exceptions. The main one is that the qualifying relative, someone who's been with you all year, does not count for head of household purposes. They can still be a dependent of yours, but they're not going to get you into head of household status. So we can't have the individual living in your house for the entire year. The other thing that changes as well is that your parents do actually not need to live with you for the entire year. So your mother and father can be outside the home. So you can actually go ahead and have them living in an outside environment, retirement community, college, whatever the case may be, and they can still qualify you as head of household. So a couple other things I just want to kind of take a look at here. So this is effectively, before we get into this, considered unmarried. If you're a single individual, you're a U.S. citizen or resident for the entire year, you're not married at the end of the year, you have more than the half of cost of keeping up a home, and that home was the principal residence for more than half the year of a qualifying child or a qualifying relative, you can elevate from single status to head of household. Now, the other thing we can take a look at is, what is that considered unmarried? Well, considered unmarried is basically starting with a married status. So what we're going to take a look at is technically at the end of the year, you were still legally married, but you are going to be planning on filing a separate return. You can't file a joint return. Now, you're also going to have to pay for more than half the cost of keeping up the home for the tax year. So that's kind of standard, what we talked about with head of household. But the other issue is your spouse cannot live in the home, will not live in the home for the last 6 months of the tax year. So what we're looking at is June 30, they need to be out. They need to be out of the house and not living in there for any part of the last 6 months of the year. So how does this come into play? Generally, it's going to come in where an individual might be going through a divorce and the parties have separated. They're now living in separate domiciles, and the spouse is not living with the taxpayer for the last 6 months of the year. Also, we have to find that the taxpayer's home is a main home for more than half the year for their child, stepchild, adopted, or foster child. Now, I do want to make this point that the grandchildren do not qualify. So if you're going to be filing a return separately from your spouse, you can only get head of household if they're not with you for the last 6 months of the year, and you have a child, stepchild, adopted, or foster child for more than half the year. Cannot be a grandchild. So just one thing to take a look at. And what do we mean by living in the home for more than half the year? Well, again, temporary absences don't count. So vacations, incarceration, illnesses, business, if they're traveling but not really making much money, obviously, to still qualify as a child, or education purposes. If they're away at school, that is considered a temporary absence. Now, what do we consider the cost of keeping up the home? We've kind of talked about this for head of household. We need more than 50%. Well, what we have to take a look at, if it does get down to that type of activity, the government can create a schedule for us to fill out, or more appropriately, the taxpayer to fill out, to show that they are providing more than half the cost of keeping up a home. And what we're talking about is literally, what does it take to maintain the home? So we're talking about property taxes. We're talking about mortgage interest expense and rent, utilities, repairs and maintenance, property insurance, other household expenses, and kind of a unique one that kind of fell under the radar for a couple of years is food consumed in the home. So for years, we kind of went through the presumption that the food consumed in the home was actually referring to things like groceries. But now we have a prevalence of food actually being delivered to the home. So if you're ordering DoorDash or any other type of delivery service, those are actually items consumed in the home. So as long as you're not going out to eat at restaurants, food consumed in the home would be part of keeping up the cost of a home. It does not include other elements we consider for support, things like clothing or education or medical expenses. It doesn't include personal expenses like vacation and life insurance and transportation. So how do we determine whether or not that an individual is paid for more than half? And again, only one person can cover more than half the expenses at each resident. So the government actually has a chart, and this is found in B13 of your 4012. And it will literally have a couple columns. One's going to be what are the elements we want to track, things like property tax, mortgage interest expenses, rent, utility, property insurance, the food, another household. We have two different columns. How much did you pay? And how much was the actual cost of those items for the year? And if you add both columns together, if the amount that you paid is more than half the amount of the total, then you have considered being paid more than half. If it's less than half, then you're not considered paying more than half the cost of keeping up the home. It may not be the worst thing. You'll just go back to your normal status. It might be either a single individual or it could be a married filing separately. Now, the last status I want to talk about is our qualifying surviving spouse status. This is our last one. So this is a very unique opportunity. This has a couple of very strict rules that have to be followed. So the taxpayer spouse has died in one of the 2 prior years. So just to let you know, if the taxpayer died in the current year, in 2022, we can still file a joint return with them as long as we didn't remarry someone else by the end of the year. But if the spouse died in the prior 2 years, this is going to make us eligible for the qualifying surviving spouse. So they have to have died within the past 2 years, not the current year. They would have filed a joint return the year that they died. The taxpayer did not remarry before January 1st of 2023. The taxpayer paid for more than half the cost of keeping up the home, same definition we just looked at for head of household. Here is the main change. The taxpayer's home has to be the main home for the entire year, not half the year. This is the entire year of the taxpayer's dependent child or stepchild. And again, we've changed this definition. The grandchildren still don't count, much like the considered unmarried, but foster children don't count either. They have to be the dependent child or stepchild. So this is a very rare, unique filing status. We don't see that very often. Unfortunately, I have seen that in my practice here. I've actually had that for an individual who her spouse had died in a farming accident in his mid to late 30s. She is at home with 8 children. So he died in 2021. In 2021, they would have filed a joint return. In 2022, she's going to file, she filed as qualifying surviving spouse. In 2023, she'll also meet the definition for qualifying surviving spouse, presuming that she doesn't remarry before that next time comes around for testing. So this is probably the most rare of our filing status. We kind of have to have the right circumstances that come into play. Effectively, usually a premature death of a spouse, and they're still dependent children at the home for the entire year. So I don't know that we'll see that all that often, but just wanted to kind of bring that up. Any questions that we have so far on dependency or filing status? Just want to see if there was anything that was pressing at this time, or if we want to go ahead and take a look at some unique filing situations and then open it up for questions again here at the end. Okay, not seeing anything in the chat. We'll go ahead and just keep going and finish this off. And looks like we'll get everyone out of here well in time for baseball fans to catch the first pitch tonight. So we'll try and keep that going here. So a couple unique filing situations I just wanted to kind of bring up here. We don't often see this on the exam itself. So the certification test, we don't often see this, but just want to bring this up for purposes of filing here within VITA. So one area that we take a look at are determining filing residency. So an individual can either be considered a resident or a non-resident alien. And we'll talk about the definitions of each. So what that'll help determine is what their filing status would be. Do they have the ability to take dependents? There are a number of people here in our community that are here on visas. If they are here on an F, a J, or M, or a Q visa, that's going to be outside of scope for Lancaster VITA. Those are traditionally going to be perhaps students that are here from foreign countries that are studying abroad. They may have had some income here, or they're teaching and they're on a special visa. They're going to be outside of scope for VITA just because of the complexities involved. Typically, what we would do with these individuals is refer them back most likely to their institution. At Elizabethtown College, we actually have all of our foreign students. If they need a tax return prepared, we actually have a system set up for them to be able to go ahead and do that. I'm sure most of the other local colleges and universities do as well. So one of the things we just want to take a look at is what is the difference between a resident and non-resident alien? So a resident alien, when we get to that process, they're effectively going to be treated just like U.S. citizens. So they're going to be taxed on worldwide income. They're going to have all of the filing status available. They can take the dependency rule. So resident aliens are going to be treated just like U.S. citizens when it comes to filing a return, meaning we're going to file a 1040. Now, a non-resident alien would have a different filing mechanism. They're going to file a 1040 NR, and the NR stands for non-resident. So again, typically who would file a 1040 NR? These would be refugees, it could be students, could be teachers, it could be trainers, they could be performers we have in the area, or even undocumented immigrants. Technically would file a return, and that would be a 1040 non-resident return. Now, these returns are actually outside of scope for VITA. So we actually cannot prepare a non-resident return. We can prepare returns for resident aliens. And how do we determine if someone's a resident alien? Well, we take a look at our tests, and that's going to be on L1 of our 4012. So this is an either or test, or I should say we'll go with the green card test first. And if we don't pass that, then we go to the substantial presence test. So the green card test is actually a pretty simple test. It's an individual who is actually have a valid alien registration card. Here's the trick. That card is not green. They call it a green card, but that card is not green. So if someone does bring in a card with identification and it's green, that's not an actual green card. That's not a legal green card. They're not actually green. So basically is a process that they've gone through immigration. They're actually lawful residents, permanent residents here in the U.S. They have the same abilities for tax purposes as a U.S. citizen does. They have preferential treatment for immigration, so they can basically not get held up in customs as much as others. But if they do not have a green card, if they haven't gone through the path with immigration to have a lawful permanent resident card, then we can take a look at what we call a substantial presence test. And this is going to be based on the number of days that they're actually here present in the U.S. And there's a chart in the 4012, again on L1, that'll help walk through the process. Now, in order to be considered substantially present, we need to have sufficient number of days over the current year plus the prior two. Now, if this is the first year they're here in the U.S., so if they only came to the U.S. in 2022, we cannot do the substantial presence test. It's a little bit more involved if it's the first year of testing. If they have been here for a while, we can certainly do the substantial presence test and determine whether or not they meet the resident alien based on that substantial presence test. So if they do, we can go ahead and prepare the return. Just one last thing I wanted to point out before we open it up for questions here at the end is for tax identification numbers. In order to prepare an individual income tax return, every individual on that return has to have one of the following three numbers. So Social Security number, that's the one that we would prefer to have. That is issued by the Social Security Administration and identifies the individuals. An ITIN, or individual tax identification numbers, it generally we consider like a temporary identification number, assigned by immigration and allows people to go ahead and file returns, but doesn't give them the same benefit as a Social Security number. And then the ATIN is actually the adoption tax identification number, and usually assigned during a process of adoption until that's finalized. So we have to have those numbers on the return. If we have them, and that's what the taxpayer gives us, we have to use those numbers on the return. Now, what could be a little unique is we may have an individual with an ITIN that actually is receiving a Social Security number on a W-2. Those numbers are not going to match. Don't worry, it's probably entirely legitimate that they're going to have a W-2 with a Social Security number. So it might be they actually have a Social Security card that says valid for work only, with INS or DHS authorization. If they have a ITIN, we're going to use that number on the return. That's going to be their primary number that we use. If they have a W-2, we enter that W-2 exactly as presented. So if they have a different number on there, we're going to enter that number on that W-2. Now, if we have a dependent who has an ITIN, they're not eligible for the child tax credit. I'll reemphasize that point as we get to our deduction and credits. in about 2 more weeks. So wanted to go ahead and do, I know we went through that fairly quickly here, just a little over an hour, but wanted to see how we're feeling. Any questions that anyone has on these areas. Again, I want to impress that this is the most difficult course we're going to have the entire session, because we're talking about 2 areas that we have to make a determination. We have to determine whether or not a taxpayer is eligible to have a dependent on the return, and also to try and determine what their appropriate filing status would be. Both of those questions can help be answered with our guides, our 4012 using the flow charts that are contained there. And also just want to reemphasize, if you have a question, if you have an issue with a return, we will always have people available to help you through the process. So don't feel that you have to make a decision completely on your own. We have a number of resources. We can have the opportunity, particularly if the issue gets a little bit more complex, we can go ahead and take a look and have your tax site coordinator go ahead and help you with that situation. We have Kim and Jennifer to help out on the VITA side as coordinators to help make that determination. And worst case scenario, I could get back involved again and help determine what might be the best tax situation for the client. So with that, I just wanted to go ahead and see if we had any additional questions that may have arisen here throughout our process. Okay, either I have taught you absolutely nothing tonight, or I've completely shocked and awed you that you don't even know what questions to ask. So either way, if you have any questions, even if you don't have them here tonight, probably the best way might be either to hold them for next week. I'd be happy to answer them at that point. Or if you want to reach out to either Jennifer or Kim with any questions, we can get those documented. And certainly we want to be able to, if there are a question that you have, probably others have it as well. So we'll try and disseminate that information as best possible. So I guess with that, Jennifer and Kim, I'll turn it back over to you if we have no questions here. All right, I'll turn it back over to the 2 of you here.
Thank you, Jared.
Thank you, everybody that came tonight. I do have one announcement that I made this morning as well, and I got a room full of groans. But for those of you who are seasoned tax preparers, if you might be interested in a bit of a challenge this year and would like to become a site coordinator, let either Jennifer or I know if you're interested in doing that, and we will get you hooked up. Jennifer, anything to add?
I don't think so. Hope everybody has a great evening, and I look forward to meeting everybody in person.